Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I'm sitting this morning with business podcast royalty. You're in for a treat, as I have none other than Ben Carlson with me today, co-host of the wildly popular podcast Animal Spirits with Michael Patnick. Ben is Director of Institutional Asset Management at Ritholtz Wealth Management and a prolific writer. He writes the blog, A Wealth of Common Sense, where he explores market history, behavioral finance, and wealth building strategies, in addition to now 5 books. Carlson's work focuses on long-term investing, simplicity, and behavioral discipline, helping investors understand not just how markets work, but how to navigate them successfully over the long term. We're going to talk today about his latest book called Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. On the dust jacket, one of my personal heroes, Morgan Housel, said Ben had mastered the art of exposing the few big topics that matter most to investors, which to me is high praise from another great author who makes finance accessible. I certainly enjoyed this book, and I really look forward to discussing it with him today. Welcome to the show, Ben.
Thanks for having me.
So before we dig into your book, Ben, I want to talk a second about what's been happening on your podcast, Animal Spirits. Great name, by the way. Love me some John Maynard Keynes. I'm curious what's been resonating or maybe been challenging with your audience lately. I know that's a big topic because you guys cover a lot of ground on any given episode, but I'm curious what's got people excited or worried in this sort of bull market extendamix.
It seems like AI is bleeding into everything. And it's funny because there are people who are terrified of AI as it relates to like the impact of the labor market. There are people who are excited about AI in terms of like what the technology can do, what it means for investing implications. There are also people who are trying to figure out which stocks are going to benefit, which stocks are going to get crushed, all these things. It seems to just be bleeding into everything. And I'm using AI more, right? So it's one of those things that is just becoming more ubiquitous. And some people say, stop talking about AI because it's all doom and gloom about the labor market. Other people just can't get enough of it because, again, the separation between the winners and the losers, like you have these one group of stocks that's crashing and this one group of stocks that's going crazy. And I don't know, times like these to me, when you're in the innovation and people are extrapolating and trying to like figure stuff out on the fly, that's really exciting as far as I'm concerned.
Yeah, for sure. And I know a recent episode you guys were talking, finding a bit of a silver lining on the labor side, finding some stats or some people that felt like it's not necessarily doom and gloom, that people will adapt, that we've always adapted. I found that personally reassuring, that I don't need to be as worried about people becoming chronically unemployed around us.
Yeah, I'm a glass half full kind of guy, but that's generally my take, is that sometimes the transition periods are very difficult, but we have a dynamic economy, and there's constantly new jobs being created, and I think and hope that's what will happen this time too.
Yeah, me too. So just before we get into the book here as well, I'm just curious for folks to get to know you a little bit as well. For folks not familiar with your story, maybe do you mind just walking us through your role and history at Ritholtz and what motivates you to write and talk about investing?
Yeah. So my background was in the nonprofit space. So I mainly, when I started my career, worked with endowments and foundations and pension plans, and worked for a single investment office for a billionaire family for about 8 or 9 years, and really enjoyed it. Got to work with all these different asset classes. We were working with public equity managers and fixed income managers and hedge funds and venture capital and private equity and all these things, and it was very interesting. But I just kind of got the itch, like I don't want to just work for one large rich family. I want to work for a bunch of different people. I want to help people with other things. So I got kind of the itch to help others, and that's what led me down the road to start to write. I said, I get questions all the time from I'm like the CFA guy, right? I'm the finance person of the family. I get questions from my family and friends as the finance guy, and I get these questions from people who are just regular people, not in the finance world. And I thought, well, how can I just explain the topics to them that are easier to digest? And so that's when I started writing. That was the whole impetus behind my writing. And it's funny because after I started writing, I started hearing from financial advisors saying, hey, I really like the way that you explain this. Can I use this for my clients? And that was never the intention for me. I was just trying to talk to normal people. And I thought, and then that kind of led me, the writing and getting into like the financial blogosphere in the early 2010s. There was a whole community of people. It led me to get to know Josh and Barry at Ritholtz, and eventually joined them and broadened the base out a little bit. So I've been there for a little over 10 years now. And selfishly, the process of writing for me it's a way to learn, and I enjoy the process. Someone once said that writing is figuring out what it is you really think about something, and I feel like I have all these jumbled thoughts in my head, and writing helps me clarify them. it helps me communicate with clients and our financial advisors better. So I've just found I've gotten a lot of benefits personally from writing.
That's interesting. When you say that, it definitely resonates with me, and I think it's true as well. Hopefully we don't all lose that as we surrender to feeding a handful of bullets into an AI tool to write it.
But I can tell when I get an AI written something, right?
Yeah, me too.
For my book that came out, I'm getting all these PR emails from people. And I can tell immediately one of them is from AI, because it just takes the description from Amazon and it summarizes it. And I say, I'm not going to read this if you're not going to write it yourself, right?
Yeah.
So I do think that people who have their own voice and can share their voice and be creative, that's going to be a way to stand out from the crowd in this more tech-driven world.
Yeah, and when I was looking as well through your resume, I mentioned at the top there that you director of institutional management at Ritholtz as well. I mean, that skill set that you described of being able to describe things for multiple levels of comprehension must come in really handy. And that I know I used to do that job as well at another firm. And the boardroom can be oftentimes, especially with multi-employer plans, you can have half the table is corporate. You get the CFO and the CEO, and the other half are shop stewards from the union plan. So being able to explain at a level that's it's understandable for laymen, as well as add some value for the folks that understand what you're talking about.
Yeah, you're right. And those kind of plans you're dealing with, people always ask me, like, what's the difference between individual wealth management clients and institutions? And I say it's the politics and the group decision of it, right? Yeah, you have committees and you have board members and you have maybe alumni or donors or whatever. And yeah, you're right. They're from all walks of life. Some of them are very investment knowledgeable. Some of them aren't. We have clients who are like firefighters and police officers, right? And again, so education is a big piece of it sometimes for that. So yeah, you're right. That communication piece is really, really important.
So let's talk about your book, Risk and Reward. I was actually talking yesterday with a new client at our firm, Leith Wheeler, and we were trying to help prepare her. She was kind of new to the investing world for kind of what's to come. She has sort of a high drawdown expectation relative to her assets, so it was going to require relatively high equity allocation. It made me think of your book, actually. So can you start us off with maybe a discussion of that trade-off of volatility? Like, why is volatility a necessary price of admission for equity returns, and how should investors mentally prepare for those drawdowns?
Yeah, I like that you described it as a trade-off, because that's what I think almost all investing and financial decisions are. It's a trade-off, right? If you want to earn higher expected returns, you're going to have to deal with volatility. And I think you wouldn't get the high returns you get in the stock market if there wasn't this threshold of pain, right? This volatility and the fact that you could have these crashes that exist in such a swift and fast manner, and lost decades and all the bad stuff. You wouldn't get the good stuff if you didn't have the bad stuff. That's kind of the way that I view it, because people there's so many different opinions out there for the way the stock market as a whole, right? People have different time horizons, different styles of investing. There's traders, there's speculators, there's algorithms, there's the long-term bogleheads. There's all these different people that are trying, and that's why you have, the gyrations that you do in the stock market, because people have different time horizons. They have different needs for when they need their money and what they're trying to do with it. And so I think without that volatility, that price of admission, you wouldn't get the high returns. If you could just clip 9 or 10% every year in the stock market, and people knew that was coming, everyone would have their money invested in it, right? It would be too easy, and then it probably wouldn't work anymore. And I think that's part of it. The only reason it works is because you're able to hold on through all the things. And that's one of the reasons I wrote the book, is to show, if you look at the past 100 years, there's all this really nasty, gnarly, bad stuff that's happened. And despite that bad stuff, the results have still been good. It's not like you just get the good results by sidestepping all the bad stuff and sweeping it under the rug. It's part and parcel.
Yeah, exactly. And it's about having the mettle to see through that. One of the things you also touch on in the book is about, I guess, just long-term focus. Perhaps I'll just put it to you this way. So who's Bob? Who's Bob, and what does he teach us?
Sure. So it was when I first started my blog, actually. And I remember we top-ticked the market in the Great Financial Crisis in October of 2007. And we didn't hit new highs again until the spring of 2013. So it was a long time. And so once we hit all-time highs again, it wasn't like people were celebrating. People were nervous because they go, oh my gosh, I remember the last time this happened. And are we going to run off a cliff like Wile E. Coyote and fall? Is it going to be the same thing? And so people were worried. And so I got the idea. I said, okay, fine. Let's say like this is a peak, which is kind of funny to think about now. That was like 12, 13 years ago. And we've had many, many new highs since then. So I said, let's just say you were a person who had the worst luck in the world and you only invested at market peak. So I came up with this story about a guy named Bob who just hoards all of his money in the bank until he's ready to buy, and it always is right at a peak, right? So he invested over 45 years. So he invested right before like the 1970s bear market, which was bigger than people remember, the 1987 crash, right before the dot-com bubble blew up, and then right before the great financial crisis. So he made 4 purchases. But his one saving grace was that he kept his money in. When he put the money in, he kept it in. Even though he put the money in and there was immediately was a crash. And the results were way better than I would have anticipated. And he ended up a millionaire based on like a lot of the numbers that you can find in the book or whatever under my blog post. But the IRR for him was like 7 or 8%. It was actually pretty good. It was better than you would have assumed. And obviously, I think I ran the numbers too. If he would have just dollar cost averaged it in, then he would have doubled his money or something. He would have done better. But the point was, a longer time horizon can iron out a lot of mistakes, right? And that's the idea that I was trying to get across there, is just like the time horizon is the ultimate equalizer. And I think the big point of the book too is just understanding what your time horizon is, whatever you're investing in, right? You don't have to be a long-term buy and hold Vanguard index investor to have this mindset. I think you just have to define like, how long am I holding this for? And that helps you define kind of your risk parameters and your goals when making any investment.
Yeah, I feel like I'm attributing this to Morgan Housel. Maybe I'm wrong. But the term that springs to mind of time in the market is more important than timing the market, which is seems to be the key point of your point there. Can you talk a bit about dollar cost averaging, like as a strategy, how it helps investors outperform?
I think I don't know if it's outperforming. I think it's more like a psychological test, because we have. First of all, most people dollar cost average because that's just how they get paid, right? They invest out of their paycheck, right? I get paid every 2 weeks or every month or every week or whatever it is. And when I get the money, I put a portion of it into the market. And it just works like that because it's convenient, right? I think that's one of the best parts about like a workplace retirement plan, is just that it's convenient. It's taken out of your paycheck. You never see it. But we have clients who come to us with a lump sum for whatever reason, right? They've got a big inheritance. They've sold some stock from somewhere else, and they're sitting on a lump sum of cash. And they know they need to invest it, but they can't force themselves to do it. So we always talk them through the numbers. And this is kind of like a facts versus feelings kind of thing, right? If you look just at the facts, and I have a lot of them in my book, you would say the probabilities tell you to put the money in immediately. Put a lump sum in, because 3 out of every 4 years on average, the stock market is up. So that's pretty good odds. If you had those at the casino, you'd take it every day, right?
Yep.
75% chance of a gain or whatever. But most people think, okay, I know the numbers. It makes sense. You've shown me all the graphs. I get it. But what if I'm the one who has bad luck like Bob, and I put it in,
yeah.
and then it crashes? So everyone has that mentality of, this is me. It's only one chance, and it's going to. So for most people, psychologically, it's just easier to break it up and do it over 12 months or something, or 6 months, and you put it in once a month or once every 2 weeks, whatever the cadence is. And what we tell people is just, all right, fine. If you're going to go the psychological route, just pick a plan and stick with it, come hell or high water. Like, don't try to adjust. You could say, listen, if the market falls 20%, maybe I'll speed it up a little, fine. But whatever your plan is, like, make it ahead of time and follow it faithfully without trying to second guess yourself.
What about folks that are on the other side of that spectrum? Can you talk a bit about what psychological forces make investors believe that they can time the markets?
The funny thing is, I think the worst thing that can happen to you as an investor is that you do it once and you get it right. Right?
Totally.
You do it and you go, oh my gosh, this is easy. I'll just keep doing this, right? I'll get out before the turmoil, and I'll get back in after the dust clears, and it's easy. And it's funny, we had so many people who came to us in the mid-2010s, 2013, 14, 15, who said, I got out in September of 2008, right? Lehman Brothers was going under. I got out. I saved myself from another 30% of pain in the market. And then I could never get back in. And I think that's the hard part for people, is like, you have to be right twice, when you get out and when you get back in. I think it's really easy to get out and just say, all right, I'm tapping out. Get me out of here whenever. But it's really hard to get back in, because you go, all right, I'm going to get back in when the market falls 15%. And then what if the market goes up 30% from there? Are you using your original line in the sand, or are you moving it up, right? And then you go, well, now I need a bigger crash to get back in. And that's a psychological game. And sometimes even when the market does fall, you go, oh, well, the market did fall 15%, but what if it goes further? Why don't I try to get cute here and then try to just wait it out some more? And I think that's the problem. If you don't have some sort of parameters on those kind of decisions, rules that are baked in advance. It's just really hard because I think that cash becomes like this gateway addiction to market timing where you're just constantly trying to do it. And so, like I said, even if you do it right once, the ability to do it consistently, no one has that ability.
Yeah. You could have, 2 or 3 weeks into the COVID crash, right? You decide you're a genius for getting out, and then you missed 100% returns or whatever. I think the S&P crossed a doubling since that point this week.
Yeah, and that was a perfect example of trying to wait for the dust to clear, because nothing was getting better in the economy when the market took off from that, right? The vaccine still wasn't here. The unemployment rate was still rising. The economy, no one said okay, this is it. The market is going to take off again. Everyone said, no way, this is a dead cat bounce. It's going to roll over again. And that's the hard part is you don't know in real time the difference between a dead cat bounce and an actual recovery.
One of the things that was heartening from your book, I mean, it's a great read, lots of examples. And for one that stuck with me was just the example where you profiled what Buffett did in 2008 on this topic, right? Can you just flesh that out a little bit for us, just to give us all hope that even the smartest minds out there can make mistakes, but in the end, well, it doesn't really matter, right?
I love that example. He put this New York Times op-ed out, and I still remember the headline said, "Buy American, I am." And this is October of 2008. And this is after the turmoil of Lehman Brothers and AIG, and it felt like we did we kind of figure this out a little bit? And he even said, listen, I'm buying stocks because they're on sale. The stock market was already down 40-some% at that point. He was buying financials that were down even more. And he said, listen, I'm doing this now. I don't know what's going to happen tomorrow or next month or next year, but I think for the long term, this is a good time to buy stocks because there's, a lot of fear and blood in the streets and all that stuff. And the stock market fell another 30% or so from there. It didn't bottom for another 5 or 6 months. So he was early. The stocks that he bought, I'm sure, went down a lot more. But from that entry point, still the market is up, hundreds and hundreds of percent, right? It's been, so the point is you don't have to necessarily time these things perfectly to make out okay, right? If you're going to do it. And so I think buying stocks when they're down, if you're just trying to wait for the exact bottom, you're never going to get there. So yeah, I like the fact that even the greatest investor of all time doesn't know how to time the market, and it's not part of his process either. He doesn't try to.
Mm-hmm. Yeah, he's got that religion already that timing doesn't really matter as long as you have a long enough time horizon. Yeah. So let's move on to inflation. You provide a great overview in the book of inflation, and for me, it was great. I learned a lot of stuff when reading this book. I wasn't aware that it wasn't much of a thing really until 1940, which is kind of surprising to me. I think you said it was 0.2% per year for the previous 150 years or something like that. But obviously 2022 gave many people, certainly market makers, their first real taste of inflation. So can you talk a bit about inflation specifically, maybe look back at another time when we had a tough time with inflation back in the 70s, was uniquely challenging for investors, and then also acquired jobs, housing, and stocks, the best inflation hedges today.
Yeah, that one stat you're talking about, I saw that from a Peter Bernstein book, Against the Gods. He talked about it. And it's not that there wasn't inflation, it's just that if you look back, the periods of inflation were really high and then the deflation was really low. So the volatility of inflation. And I think that's something, the psychology of inflation is the thing that interests me the most, especially this decade, how much people freaked out about it and how bad the sentiment got. And I think the reason is in the past, people were used to volatility in prices, right? They'd spike and then they'd fall and they were all over the place. And we've had such stability in prices, right? Where we just had this 2 to 3% inflation for so long. It wasn't since the 70s that we had a big spike like we had this decade. And a lot of people weren't around for that, right? And so it's this new phenomenon. And I think the psychology behind it is really fascinating to me, how angry it made people. and I think frankly, it shocked me how angry it made people. Now, it's interesting from an investment perspective, a lot of people look at it how do I hedge it in the short term, right? Do I buy gold or precious metals or maybe Bitcoin or, tips or something? People look for the actual hedge. The hard part there is that you have to time the inflation, right? And it's funny because a lot of people I heard from a number of people who said, I was worried when the government spent trillions and trillions of dollars in 2020 that there was going to be inflation. And I bought tips and I still got killed because they bought long-term tips, which guess what? When rates rise, they act more like bonds and the inflation kicker didn't help as much. So it's the kind of thing where you could be right and the asset you pick might not cooperate.
Yeah, or to your point, timing wise, once you decide, the inflation is here, I go to buy gold, which in hindsight, I guess, still would have been okay. But at that time, obviously gold had run, right? So,
right. Yeah, a lot of time and that's the thing. I think for the way that you hedge inflation with stocks is by holding them when inflation is low, because you had really high real returns leading up to the inflation. Yeah, you had a bad year or two for the 2022 bear market, and I think that's the point. And my whole big point was that for most people, it's more of a personal finance issue than an investing issue, right? The stock market is still the best asset to hold, that gives you long-term above the rate of inflation, right? So I think that hedges, to me, as a long-term investor, that makes the most sense. So I think from a personal finance perspective, that's where I'm looking at it from, is like, how do you help your own personal situation? Because no one has the actual overall inflation rate, right? You have the global inflation rates or the national inflation rates, and people look at those and they go, are you kidding me? There's no way that's right. That's because everyone's spending is different, right? So I think it's more of a personal finance issue than an investing issue for most people.
So you talk about Shark Week in the book as well. What does Shark Week tell us about investing behavior?
Yeah, it's interesting. I was compiling these stats about Shark Week for the book, and basically it shows that, that show's been on for 30 plus years or something, and the more people watch it, the more scared they get of shark attacks. And it's funny, when the show first started, it was supposed to be like a PSA showing these animals are actually not that dangerous. There's not that many shark attacks, but they showed some shark, and they even if they tell people like these are, there's not that many shark attacks, it was like a PSA, like, hey, actually they're not that dangerous. People still got more scared. And it's funny, I'm compiling these stats, and we go to Florida every year for spring break. We go to Marco Island, and there's little channels that we stay on, right, that lead to the ocean. And there's kayaks at our Airbnb, and my wife says, we're not letting the kids use the kayaks because there could be sharks in here. And I told her, like, come on, there's no way there's sharks in there. So the next day, my son and I are fishing off the dock, and what do we see? A shark jump out of the water and grab a fish, a bull shark or something, right? 20 feet in front of us. So sometimes I tell my wife, no, honey, there's outlier events, right?
Yeah.
We play the probabilities, but there's outliers. So.
And that was it. So we're good for another 5 years.
Yeah, and I think the point of it is just like, if you pay attention to the scary stuff all the time, like the markets, and that's all you do, it's going to be hard to ignore it. And the more you pay attention, the harder it is to avoid doing something, right? And becoming scared. And unfortunately, the old trope for most financial advisors and wealth managers is just ignore the noise, right? That sounds great. It looks good on a plaque on your desk, right? But it's impossible now, because we have these little pieces of glass in our pockets that are giving us alerts 24/7, and it's impossible to not know what's going on. So rather than try to ignore the noise, you have to try to filter it and, not look at your account as much, and have limitations on your process in some way. So you're not, reading every piece of news and acting on it.
Yeah, definitely. And what you're describing is trying to tune out the noise from the short term. One of the things you talk about as well in the book, or you write about, is just preparing for and accepting that there are going to be big corrections. Can you talk about the concept of normal accidents that you explore and its ties to the space program?
Yeah. There was this guy named Charles Perrow who wrote a book called Normal Accidents. And he said, anytime you're dealing with a complex adaptive system, the safer you try to make it, the risks never go away completely. They just kind of change shape. And yeah, I love that Apollo 13. I love the movie, but I read a couple books on it. And the way that they describe what happened, they're like, listen, we could have run tens of thousands of simulations to show what could go wrong on this, and we never would have come up with this. Like, the oxygen tank exploded because this one little piece. And they said that the oxygen tank exploding, it was such a big explosion that if you were looking up that night at the sky, you could have seen it from the Earth. And the fact that they were able to get these guys back after trying to land on the moon is kind of a miracle. They said, like, NASA runs on checklists, but we looked for a checklist to do that in this situation. We didn't have one, so they kind of made it up on the fly. And I guess the investing corollary there is, you don't want to have to make things up on the fly. You want your checklist to take account for bad things can and will happen. And again, back to the price of admission thing, that's just a normal part of investing in the stock market. Occasionally there's going to be crashes. I think Munger says, listen, 2 to 3 times in your lifetime, you're going to have to withstand the stock market falling 50%.
Yeah. And hopefully you got cash on hand at that point, right?
Yeah, yeah. And the funny thing is about like the Great Depression, they said no one had any cash left because they bought the dip and the market
they couldn't
just kept
take
dipping.
advantage.
Yeah. So, but it is something that, there's at some point, things are great right now. There's going to be a financial crisis someday. I don't know if it's going to be a year from now or 5 years from now, or maybe 20 years. You never know with these things. Like sometimes there's a long period of calm in between, but it's going to happen at some point, and you have to figure out whether you're going to have a portfolio durable enough for that, or just have the intestinal fortitude to hold on to it.
What is the perfect portfolio?
Well, I like to say that the perfect portfolio is only known to the benefit of hindsight, right? You can't create it in advance. It's funny, my first boss in the industry used to draw like the efficient frontiers of Harry Markowitz, and he didn't put all the asset classes and calculate the covariances. And I learned that early on in my career. But he would always caution his clients of, listen, this is the past portfolio, right? The future portfolio, we don't know. So we're making, we're doing our best here to get you close. But if you want to quibble about like 2% in small cap value versus 3% in large cap growth, or whatever it is, like at that point, you're splitting hairs. It's kind of like horseshoes and hand grenades, close enough, right? And so I always say the perfect portfolio is one that you can stick with. And most of the time, shooting for perfection, like perfect is the enemy of good. And so I think for most people, it's finding something that you can stick with. I like to say that like the good strategy you can stick with is far better than the optimized strategy you can't stick with. And a lot of times that comes from knowing yourself, knowing what, is going to allow you to sleep at night, knowing what your goals are, all of that stuff. So the point is there is no perfect one for everyone. And for every investor, it's kind of what you can deal with.
Ben, you talked a bit about your way in, your early part of your career there. And I have a question I ask all my guests here, which is to go back to the early part of your career. And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
Well, that's a good question. First of all, it wouldn't be coffee because I'm not a coffee drinker. I've actually never had a cup of coffee in my life, which is surprising.
I feel very sorry for you.
I think my wife always says that too. I think I would just tell myself to have an open mind, and that there's so much that's going to happen that's going to be surprising. Just don't be surprised that you're going to be surprised, right? Because there's so many things that have happened. If I look back in my 20-year career in this business, that I never would have possibly, could never have possibly planned for. The risks that people think are the big ones never seem to be the ones that bubble. Like it's always, and the next risk is never like the last risk. So I think I would just tell myself to have an open mind and just keep wanting to learn and improve in this industry, and just know that like you're never going to have it all figured out. Like no one ever gets to the point where they go, okay, I've got the markets totally solved. Now I'm done. I can sit back and relax. I don't think you ever quite get to that point where you know exactly how things are going to play out, and you just have to be okay dealing with that like irreducible level of uncertainty.
I've been speaking today with Ben Carlson, CFA, Director of Institutional Asset Management at Ritholtz Wealth Management, co-host of the Animal Spirits podcast, and author of the blog A Wealth of Common Sense, along with now 5 books about investing, the most recent of which, that's a big mouthful, is Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. Thank you, Ben, for your time and insights. It's been a great chat for me.
Thanks for having me.
I'm Mike Wallberg, and this has been The Enterprising Investor.